Welcome to FMH InsureCast, a podcast created by Farmers Mutual Hail designed to deliver expertise and insights from trusted FMH team members and industry experts. Each new episode will dive into new products, industry updates, and innovative solutions. Let's get to today's topic.
Well, hello and welcome back to the FMH InsureCast. As you can see, this is a special edition of the FMH InsureCast as we're here on video. And I'm here with Ken Ripley. Ken Ripley's been on the show several times. Ken, go ahead and reintroduce yourself.
Yeah, Ken Ripley again from Blue Earth, Minnesota, regional sales manager for the Northwest region of Farmers Mutual. And it's always great to be on here with you, Ryan. So
yes,
looking forward to our topic today.
Well, I appreciate it. And I love your perspective as not only somebody that works in the crop insurance industry, but as a farmer yourself. You offer a unique perspective. That's why we like to have you on here. So
glad to be here.
And once again, my name is Ryan Bennis. I'm the host of the FMH InsureCast here. And I'm also in the marketing side of things here at Farmers Mutual Hail. So what we got today is a very exciting topic, margin protection. We're sitting here in August, but we're talking about a product for 2023. So we're well ahead of the game here. But the reason for that is that margin protection has a sales closing date of September 30th. Right. So, Ken, I'll start off by just pitching you this question. What is margin protection? What makes it unique out there versus the other options that we have?
Yeah. So it is it's a 95 up to a 95% county-based policy, multi-peril. So all perils are included with it. Very similar to ECO, if you're familiar with that product. The difference is one of the biggest changes with margin versus ECO is that it is from 95 down to your multi-peril level, and it provides input risk. So if there's, we're tracking inputs from a wholesale standpoint, up or down, and if there's a change in that and the risk goes up, obviously it benefits the producer from a loss. The other thing is that because it overlaps with your multi-peril, there's some subsidies that are offsets that are done from a premium credit that actually don't have them with our ECO product.
Right. So what Ken's mentioning there is that we get a benefit on the credit side of margin protection with premium if we have that underlying policy with us. And the main reason for that is because the two payments offset each other.
Yeah, they're both down like 95 to 0. And say you buy an 80% multi-peril, that's 80 to 0. So now you have an overlap in that 80% on down. That's why there's offsets.
Correct. And so essentially, if you have both those policies, which we do recommend buying them together, you would get the higher payment of the two. And in a typical year, because margin protection is that higher level, you're going to get payments from margin protection more often and at higher dollar amounts than you would on your individual policy.
Correct.
Okay. And I think the maybe the most important part about why we're talking about it now and the sales closing date in September is because we get this extra price, right?
Correct. Yeah.
We are just starting. It's actually the beginning of the pricing period for margin protection today as we record. The pricing period runs from August 15th through September 15th, and we get to use that price as the basis for our insurance coverage on margin protection.
That's correct.
Something we don't have the option to do under the RP plan. So we essentially get a third price, right? We get a margin price, a revenue protection price, and then the harvest price actually matches between both of the policies. But as we look back just a little ways, Ken, 2022, we saw a big jump in the amount of policies sold in the industry. Yeah. Can you help explain why you think that might be?
Yeah. So last year, as farmers know, input costs went up substantial, and there was a big scare that they were going to keep climbing, which they did. And as a result, locking in something in August, September timeframe was a good decision because inputs went up so much. So I think that was the big driver. Plus, we were at a 506, for example, on corn. We had a nice, fall price or spring price for margin to lock in. I mean, who knew that we were going to go to some of the prices we saw?
Sure.
So that was one of the catalysts, but we're right there again.
Right, exactly. And so at the time, 506 on corn, we were 1256 on beans. This was last fall. Those were some of the best prices we had seen to that point. And now we've eclipsed that, and we're looking at even higher prices for 23. So what I have here, and it's minute to minute, right? Changes a little bit, but so far for December 23 corn, which is the price we're using to establish our beginning price on corn, is at $5.90 or very close to that. And at soybeans, it was about $13.40 as of yesterday afternoon. So that's November 23 soybeans and December 23 corn. Obviously, those are higher price levels than 22.
Right.
So we may assume that we may also see another jump in margin protection sales.
I think so. I mean, inputs are still, there's a lot of uncertainty in the world going on. We don't know what's going to happen there. And, I'm from Minnesota and our crop looks pretty good. Can we hold these prices through harvest? I mean, there's a lot of time between grain being in the bin. And so who knows what's going to happen between now and February.
Well, and we'll talk about that a bit later here. With how much risk we have in the next 6 months, because this is, again, an opportunity to buy a policy now versus waiting until February.
Right.
So we'll talk about some of the risks we face. But just a quick visual for you all at home. This is a map of the amount of policies sold in the industry for margin protection in 2022. So one thing I just point out when I see this map, Ken, is that we have a pretty good spread of policies. And actually, you don't see a lot of written outside the corn belt here, but that's somewhat limited because of where margin protection is available.
Correct.
But as far as where it is available, the spread from east to west, even north to south, is fairly even. We're definitely seeing expansion of margin protection interest outside of, the I states, so to speak.
Correct. Yeah.
So,
as you'll see, I mean, very successful in sales in South Dakota, which is definitely has an increase. Even, the number that are up in North Dakota. I mean, it's definitely expanding outside the traditional I states, which is good.
Exactly.
Especially for a product that couldn't be sold east to west, right?
Right. Exactly.
It was conceived area-based plans weren't popular past west of the Mississippi.
The old rule, right? You didn't sell them east of the west or west of the Mississippi, but that has certainly changed. So, Ken, to your point, input costs are built into this policy.
Right.
Last fall, when we were doing, when we were sitting here recording our podcast, we were actually in an environment where I would say input costs were average to low.
Right.
And now we're in a much different environment. In fact, almost immediately after the input prices were locked in last fall, we had the Russia declaring war. We had supply chain issues rearing their ugly head. And all of a sudden we saw those input costs increase dramatically. So how did that affect the policy in 2022?
Yeah. So for example, like on corn, from what we I'll call them the fall prices to the April price discovery on corn, we're seeing over $100 an acre increase in the input costs. So what that does for the policy is it moves that yield trigger from a county yield standpoint much higher. So it favors the producer from a trigger point and a loss. And we're in some of that same area here again, and with uncertainty. The bigger issue that we're maybe, I shouldn't use the word issue, but we're tracking wholesale prices with these inputs. As a farmer, we're obviously buying retail. There's a little bit of a disconnect right now because those prices went up. The retail came down, but it hasn't come down at the same level that the wholesale has, which is actually better for the policy. We're starting at a lower level with the policy. So if we do see another run up between now and April, it'll benefit the margin policy.
Right. And you're making a good point there about being in a good position with these input costs, because the opposite can also happen with these input costs, right? If we're in a position where our input costs are very high now in the fall and they drop between now and next April, that can actually have a negative impact on our trigger, on our chances for a payment with margin.
Correct. Yeah.
So it's good that we've somewhat come back to earth a little bit with these on the wholesale. But to your point, those retailers had to buy at the peak, and they're still trying to offload those fertilizers.
And with the transportation costs, that's driving the wholesale prices that much higher because, as we all know, diesel has not come down as aggressive as gasoline has. So that has an impact on the transportation costs.
Right. So trying to back up just a little bit on these input costs, just to put in perspective how much impact they have on the policy. We do have this table here that shows the actual impact of those input costs, positive or negative, on the policy, going back to the policy's origination in 2016. And essentially what you see here, this is one county example, but all counties are going to be fairly similar to this. is that up until 2020, the impact of these input costs, positive or negative, was very small.
Right.
Almost, a bushel or two at the most. It wasn't having a huge impact. 2021, we started to see a little bit of a bump in those input costs. And then in 22, we just went through that. Huge increases in those input costs really drove up how the impact of the input costs affect this policy. I would say, though, that 22 was definitely out of the norm. Is that fair?
Yeah, especially since it just exploded really after our discovery period. Potash doubling. All these things just went crazy. So it's it definitely had a bigger impact than we probably will see in 22. And from a farmer standpoint, I hope that's the case, because we want these to come down so we don't have as much risk on the dollars we have to spend to get that crop ready for the next year.
Exactly. So I think, just to put that all in a bow, the input cost side of this policy is generally not a huge impact. We're talking a few bushels here or there.
Right.
But it does have the potential to really both help or hurt our chances for a claim payment. Okay, so we talked a little bit up front about the payment offset and then the credit that you get.
Right.
One important piece of this, again, looking back to 22, so we can tell the story for 23, is that in 22, we bought the policy last fall at $506, say, on corn, and then the price ran up to $590 in the spring.
Right.
And as we talked about earlier, we're going to recommend that, yes, you still go ahead and buy that RP policy. Because it ran up to $590, that policy, that underlying policy, became worth more.
Right.
And actually caused bigger credits on the margin side of things. Yeah. How does that make you look at this policy a little different at this point in the year?
Well, so one of the benefits with that is, because, in my case, I bought a HPO policy, a harvest price option policy, which helps me because now on that fall price, the revenue policy and for the margin, they're going to have the same price. So getting that reduction, in my case, it ended up being where I essentially got my revenue policy for free, plus a few more dollars of credit back.
It's a nice deal.
It was a very nice deal.
Yeah.
But you have that risk because there's more risk on the RP policy, there's risk taken off the margin. So we're really looking at, hey, is the county going to yield? What are the margin inputs going to do? And that's what's going to drive where our losses will be at. So who knows? Crop looks pretty good up there, Ryan. I'm not sure I'm going to have a margin loss, but that's okay. I'd rather sell the bushels.
That's okay. I bet if I told you, hey, Ken, if you buy this margin product right now, I'll tell you the prices, you're going to get another $2 a price if you want it. And you're going to have great yields. Would you felt okay about that?
I wouldn't have believed you.
Okay. Well, I don't blame you there, but yes. So just a note on that. If the prices were to go the other direction, so that we set a highest price in the fall here with margin, and then we ran down to the price in the spring in February, then the discount that we would get would be less.
Correct.
And it is a grower to grower discount. They're very hard to estimate what those discounts can be. But just plan on, if you had a discount in 22, that's probably about the best you can hope for at that situation.
Yeah. And as if you're working with your agent too, just have them just understand that it's a guess at this point on what that discount's going to be, because looking back at all the years it's been available, they're not the same. Never. I don't think we've had 1 year that's the same.
No, not even close. So let's turn our attention to 2023. We mentioned this before, but we're about $590 on December 23 corn, $13.40 on November 23 beans. Inputs, as we established, they're not really that high or low in the policy today. Does margin protection make sense for me? I think that's the next question, right?
Exactly.
We know what the prices are. We kind of got an outlook for the risk, and I think we can kind of set the input costs off to the side a little bit and make a decision about whether we want to buy a 95% county plan right now with this opportunity, with this price. So tell me a little bit about the decision making in your head.
Really, you need to look at this more like, hey, I'm buying this as a put. Is probably the way we need to look at this product. Is I'm buying as a put. It's giving me a floor on price, and it's also protecting me if I have bought some of those inputs, but I haven't marketed that grain. That's where we're getting the put on the grain side. So, and we'll go through more of that here as we get going.
Yep. So if you were to pass on margin protection, do you have another option? You hinted at it before with ECO.
Yeah. We've got the option with ECO to wait in the spring and come up with what that does, because that's the same 95% policy. They're both using the exact same expected county yields. Mm-hmm. So we're not getting a better yield with either product you buy, which is a nice feature of using that expected county yield for both.
Right. So we have that option, but of course, there's risks that we face right now mm-hmm. between here and then when we have that opportunity to buy ECO in February. We have 6 months, and I have a chart pulled up here just showing our last 6 months of prices on the December 23 corn contract. We were as high as 680 and as low as 540 on those contracts.
What was my call, Ryan? In that higher period to say, Ripley, get off the schneid here and sell some stuff.
I might have told more than one person to go ahead and do that.
I'm sure I missed that call. So.
Yeah. But no, quite a bull run that we had in April and into
We thought it was going to stay. Unfortunately, as markets always tell us, there's no new normal.
Right. Well, you're getting another crack at it. We were rallying recently. And then we just had some good rains come across the Midwest. So kind of tempered that run a little bit. But long and short of it is, if we look back, we got $1.40 worth of spread in the past 6 months. That's the same type of risk, I think, that we face in the next 6 months.
Absolutely.
So we may be at 590 today, but there's no promise that we'll have 590 in February.
Yeah. It's one of those crops, again, that can go based on crop estimates. It could go either way.
Right.
I mean, things in the world could change, and it could go up $1.40 and down $1.40 just as easy, and probably with the same reasons.
Right. And so on soybeans, very similar story. Up as high as 14.48, as low as 12.15. Now we sit about in the middle there, 13.48. So still a good profitable price, I think, that you can lock in today. And I wouldn't say either one of us are suggesting that margin protection is a slam dunk.
No.
But boy, there's a lot of risk that we have on the table over the next 6 months. And if you're choosing not to buy a margin protection policy, hopefully there's some other way you're protecting yourself against the potential downfall in our prices here.
Correct.
So to summarize a little bit, we talked about margin protection versus ECO. We wanted to also establish that there's a risk there involved between waiting for ECO in the spring. But even then, there's some pluses and minuses to both of those.
Correct.
I didn't know if you wanted to kind of go through a few of these, Ken, and talk through the differences between them.
Yeah. I mean, obviously, as we talked about before, on margin, the benefits are the input costs, having that component of it, which can help you and it can also hurt you. But getting that August, September price discovery is a benefit, especially, historically it hasn't been a big play, but, nothing's been normal here as of late. So 22, 23 change may lean a little bit more towards the margin, giving us some upside there. One of the benefits that you do have with ECO, though, is the opportunity to have it be just a 9 or a 4% policy where margin is 95 down to 0. So we have that overlap. You can't have a gap in your coverage.
Right.
I know this last year, we had people that liked ECO, had taken an 80, leaving a little bit of a gap and having a 95 trigger. So there's trade-offs between the two, but with ECO, you don't get the input side. So you're completely, county yield and price driving it, where margin has that extra benefit.
Right. And because of that limited liability, ECO payments are also tend to be limited to those smaller dollar amounts. Margin has the potential to pay a lot more. But margin also has potential to pay 0 if your losses exceed the margin losses.
Correct.
Maybe not if we're keeping a gap there between our level and the margin level. That maybe wouldn't be super common, but it is a potential risk that we have.
Upside too, though, with that is if you're buying a 95% margin and you have good yields and the county does not, you could see that full payment even if you have excellent yields, which is definitely a benefit of not having a gap in your coverage like ECO can have.
Yep. So overall, I would say the two policies, although margin might be more complicated in the way that it's structured, the two policies, I think, from a risk perspective, are fairly balanced.
Yes.
They both offer protection on a county level above where we're at. They just do it in a little different way.
And they both pay the same time. There's no advantage in one or the other as far as when payments come from the policy.
Exactly. So I did my best. I was walking my dog one night. I did my best to try to simplify this and thinking through how do we sell a margin protection policy, which frankly, we could probably talk about for several hours. So imagine trying to have that 30-minute meeting with a grower and going through all this. And so this was my best way of approaching this policy. And first being is that we have to establish what our risks are for the next 6 months. And we talked about that already. But obviously, we have price risk between now and February. We also have input cost risk between now and February. If we haven't purchased our inputs already, then they have the potential to increase between now and whenever we pull the trigger on those. Yes. So those are our risks for the next 6 months. And then because we have this margin protection policy, we have to figure out if it's a fit for the grower based off the answers to these two questions, which have you sold a majority of your crop? Have you locked in a majority of your inputs? And both of those are yes or no questions, right?
Exactly.
I would say we can go to the next slide here, and we have a lot going on with this slide here. But essentially, it's categorizing our growers into these 4 quadrants based off of the yes or no answers to those questions. So if I've sold grain, yes, I've sold grain. I'm on the left half of this circle. And if I haven't, I'm on the right side. And if I've purchased inputs, I'm on the top half of this circle. And if I have not, I'm on the bottom. And so whatever 4 of those quadrants growers fit into, we have different perspectives on margin protection for that particular grower. Let's start with probably the unicorn of the group.
Yeah.
The unicorn.
Let's start in the upper left. Right?
Yes, upper left. The unicorn of the group, which would be that we've sold a majority of our grain already, and we've purchased our inputs for 2023, not 22. Not happens a lot. Not happening a lot. Yeah. So if this was a true pie, it'd be a pretty small sliver. But we do have growers that could fall into that category. And for the most part, margin protection probably doesn't make sense for them.
Right.
They don't have that price risk over the next 6 months, and they don't have any input risks as well.
Yeah.
So let's go to the next most unicorn, right? Which is that they still, in this case, have sold the majority of their grain, but they haven't purchased their inputs yet.
Correct.
I think the key here is, well, we saw that table earlier, Ken, with the potential benefit or detriment of those increases in input costs.
Right.
And what was the biggest number we saw on there?
Yeah, it was, $100 we had in 22. Most of the years, 21 was in that 40 range, but a lot of those years were plus or minus $10.
Right.
Not big swings from one year to the next. So the risk up and down is not
pretty small.
Not probably worth the cost of a margin policy.
Exactly. And that's the point there is, right? So we do have risk between now and February of whenever we lock in those input costs. However, the potential benefit on the policy side for those input costs running up is basically at maximum $100 or so.
Right.
And we might be spending half of that or more on this margin protection policy.
Correct.
So now let's go to maybe the next most common producer, which is not sold any grain or very little, but they have purchased their inputs. And so their risk that remains is that we still have prices declining, our commodity prices declining.
Right.
We think that margin might be a little more viable for this kind of grower.
Yeah, especially because when you think about we're capturing at the time we're buying inputs is probably now. I mean, we're talking to retailers, obviously, as farmers right now, because it won't be long. We'll be putting some of those down. So if we're locking those things in, we're locking those in with decisions based on prices that we see for the next crop year. So, yeah, I think that's a good fit. And that's going to catch a lot more. This is going to be the most common. This is
a bigger piece of the pie.
Yeah, this is because we're buying inputs for a couple of reasons. Obviously, to get a start on the next crop year, but we're doing it for tax reasons as well. A lot of producers want to capitalize on some reduction for the year that you're in right now. So, that's me.
Sure. So here's my perspective on that. We're walking into this margin sales season, and at least halfway through, or if not towards the end, we'll have our prices pretty well known.
Yeah.
I think as a producer that's locked in some, or if not all of my input costs, I got to go ahead and do my quick tally of what my cost of production is.
Right.
And if I can see a clear profit with the prices that are established under this margin policy,
correct,
I have to think hard about taking it.
Yep. Yeah. Or at least you need to do some hedging of some other way. If you're not going to buy margin because maybe just you don't feel it's a fit, as a farmer speaking here, I need to do something.
Right.
And all that risk out there, prices tank, and I bought it at these higher retail prices on inputs. My margin on my farm got substantially squeezed, and that's not where we want to be if we want to farm for the future.
Exactly. And so sometimes we balk at the premiums that are associated with margin, and no doubt they're not cheap as even insurance goes. But when you think about what would happen if we dropped 50 cents off the price between now and February, we drop 20 cents on the price in a day sometimes.
Soybeans saw 60 cents just a day ago.
Not even soybeans. I'm talking corn, but so that day-to-day risk and the risk over a period of 6 months is very real.
Such a volatile market right now. There's more than we've ever seen.
Right. And so then we have our last category here. This is our holdout category, I guess I would put it as, where they haven't done much of anything yet as far as selling any grain or purchasing any inputs. And I would say they're in a very similar category actually as the previous category we're talking about here.
Right. So because say you haven't locked in your inputs, like I said, retail prices, hey, I'm going to wait them out. We think the retail is going to come down. Nothing says that they just don't skyrocket back up. So that's where if we lock in, we have a price and the margin input costs move up, margin is going to protect that upside, just like we saw for the 22 crop year.
Right. And maybe another way to put that is if I really believe that input costs could come down, or I'm waiting for that time, this policy buys us more time to do that. Yeah. It gives us a little extra, at least locks in a floor.
Let's wait out the retailer. So
exactly. But we'll see.
We'll see.
Not suggesting that that's the ideal solution, but if that's a strategy that a grower wants to use, this policy can help you feel good about waiting out a little bit longer.
Right.
So, okay. These are just some definite questions for both farmers and crop insurance agents to ponder as we enter into this season. And I'll actually pose most of these questions to you. I don't want to get into your financials 100%, but what would you say? Do you have less risk this year than previous years?
Substantially more this year.
And that's because of how many more dollars you're putting into the crop.
I was lucky enough last year to buy my inputs ahead of the big run up. This year, for example, potash is double of what I paid a year ago. Hydrous, all those things have gone up. So my inputs, my cost, my break even is at a point significantly higher than 2022 was.
Sure. Okay. Makes sense. So we still have, though, in the eyes, I think myself, that still prices that are profitable today.
Yep.
And so do you have a margin per acre in your head that you could lock in that you feel good about?
Yeah. You can definitely, some of the margin that we wanted to have in what was the normal years is still available today. We've been spoiled with some true profit margins of some record levels over the last year. So we realize that we can't have those last forever. So yes, there is definitely a good margin. If you're shooting for $100 an acre, whatever, that is obtainable even with these higher input costs. It just comes at a much higher risk.
Right. And so I think the question that each grower has to ask themselves when they get to this point is, if I have an idea what my costs are and I can see the prices that I could lock in with margin, I have to look at this and think, okay, if my premium is $60 an acre, is that worth locking in my margin of XYZ?
Yeah.
And for a lot of growers, I think that answer could still be yes.
Yeah. Absolutely. Especially with, if we're going to stay in these 590 or range on spring price for this product, that adds a lot of cushion.
Perfect. So then the last question, which we kind of got to already, was if we're going to pass on margin today, how else are you going to protect your crop risk over the next 6 months? Because margin is not the only answer. We can sell grain, we can use options, we can find other ways to lock in prices as they are today without giving up our upside.
Correct. Yeah. And thinking you have it put their best. Doing nothing is doing something.
Right.
And unfortunately, that's the easiest one.
It is the easiest one.
But not always the best with the amount of risk that we're seeing in today. Right. I mean, like I say, these are numbers that I'm sure make the bankers nervous when we see the dollars we're investing per acre this year.
Right. So you mentioned earlier comparing this to a put option, which is a very good way to look at this, I think. In a lot of ways, we're hedging against this price for the next 6 months, for the next 11 months, or 13 months, excuse me.
Yep.
And so because we get to lock in this third price. So what would it cost us to protect our December 23 corn price for the next 13 months?
Yeah, I haven't looked, but I'm sure it's not.
It's $100. It's $100.
You've done the math. Okay,
it's $100 an acre.
So this is a bargain.
This is a bargain. Yes, $100 an acre to protect 95% of our corn price for the next 13 months, and on soybeans it's about $50 an acre. So buying a put option sets our floor, but it gives us the opportunity to still participate in the market if things run up, which is the same as what margin does, right? Exactly. Margin protection also has that element of yield built into it, so that if yields in the county are lesser, then we can also collect on the yield side of things, even if prices don't go down.
Right.
Comparing that to selling grain is free.
Right.
Or almost free.
Almost free. Yeah.
But obviously it doesn't allow you to participate in the market after this.
Correct.
So looking at this compared to a put option is probably the most appropriate. And I would say there's more value built into that margin protection policy as a general rule.
Right.
And then we have final slide here, just a couple charts. I think the question becomes about whether we lock in this price now or we wait. And this is just a look back at what our prices were on both margin protection and our revenue, our spring revenue protection prices for the last 6-7 years. Yeah. Any tidbits of info to pull out of here at all, Ken?
As you look at that, a lot of those, especially if you're looking at corn, most times it's not saying that this price period is the better one. But the reality is we're in a different world right now. I don't know. We're at 590. If we hold 590 through this month, can the market, if we're surprised with the yield, because I just travel around my region, I see some pretty good crops. So as long as if we don't have any hiccup there, and I know there's parts of the country that's not the case, they may offset, but this could be one of those years where it's a flip flop. And 590 is a very good price if we stick there.
It is most definitely. Okay, just a couple final considerations before buying margin protection. There's a couple of different ways to purchase the policy, and we just want to address a few of those real quick before we sign off here. One question is, what level do I take? And I would say for a majority of that map that we saw there, 95% is still the level that we want to go after.
Especially because we're dealing with an area-based plan. So it's the county yield, not your individual yield driving that. So it's more critical with those area plans to be as high as you can go. I know you can come down, and not in some cases 90 makes sense, but I would probably suggest never going below a 90 just because it's an area-based plan.
Yep, exactly. I think even if we do go down to 90%, I don't think we really want to buy a margin protection at 90% and then an 85% RP plan. We want to have a gap there, so we have some value with our margin protection policy.
Correct.
Then we have the option with this protection factor. When we buy margin, it's not based off our own APH, it's based off the county yield. And so because of the county yield is our basis, we can inflate or deflate that county yield based off the amount of protection that we need. Right. So how do you look at the protection factor?
Yeah, I like to do that as a percentage. So say, for example, if we had a personal yield of 210 and the county was 200, so we'd want to do a factor of like 105% there. That way it's truly matching up. That's why I like to look at it.
Sure.
But you can also, let's say, because margin is expensive, maybe you want to soften some of the expense. I would do the softening on the productivity factor or protection factor, versus having the trigger level.
Sure.
So keep it at 95 because you can go from 120 down to 80. So you have a big range there, but the intent of that was to have it match your APH, and you do a factor to match your APH. So it pays like your APH versus paying how the county's yield is.
Right. Exactly. Do you need the buy-up plan? We already said yes, but let's give a few reasons why.
Yeah.
You go ahead. You've experienced all these.
Especially in my region, having the Dakotas prevent plant, you got to have it. If you're in an area of prevent plant, and that could be anywhere in the country, because we are always shocked where we have some PP come into place. That is not a peril underneath the margin policy. So you want to have that individual coverage to give you that prevent plant. You want it also, let's say I get impacted in a hail event or something in the county, and the county doesn't get hit as bad. Mm-hmm. That's another benefit to have that for that more spot loss. And plus, then the third one would be cash flow. So if you've got, obviously your RP policy would pay you in the fall or early in the next year. And whereas margin is not going to pay till June of the following year. So cash flow wise, that would be a big driver.
Yep. Makes plenty of sense. Okay. This is a tricky one.
Yeah. I think we learned something this year.
Yeah, exactly. So the harvest price option. So one thing we hadn't mentioned to this point is there's two versions of this margin protection policy. One of them has the harvest price option. The other does not. Essentially what that means is if our harvest prices are higher, then with the harvest price option, we reset our guarantees. We get a higher dollar amount covered. With margin protection, just plain old margin protection without the harvest price option, we don't reset those guarantees.
Right.
And so what it means is if we have higher fall prices, these are harvest prices.
Yeah. Then
we will actually decrease our trigger for the county.
Correct.
So it could be less than 95% if that's the level that we bought. Mm-hmm. So up until 22, we were 50-50.
Especially because you have the margin or your revenue protection policy, you have the higher price in the fall. So what did we need as much? Well, 2022 is telling us, this is probably not an area you want to skimp on. Keep that HPO in, because that way we don't move a trigger. Like for example, in my county for 22, we're talking about a 30 bushel swing roughly from having the HPO versus not, because we went from a 506 to a whatever we're going to end up here. I mean, it's
high fives.
If who knows, maybe it'll be 6 yet. Who knows where it's going to track out, but that moved the dial quite a bit more than we've seen. So I don't think we're out of that big swing of volatility for the next year. So probably not an area to save a few dollars.
And I'll start by saying I agree because I think that I learned my lesson last year. So I would agree. However, if I could play devil's advocate, because I think there are some people that would advocate for dropping the harvest price, it's around a savings of about 20 to 25%. Yeah. So if we're looking at a premium of $80 an acre with the harvest price, without the harvest price, it might be 65, something like that, or a little less. And the theory there is that we're buying margin protection now with the notion that the margin protection price right now, this $5.90 on corn, is the best price that we could get.
Right.
And if they're right, if this is the best price, then the policy's worth the same. Right. With and without the harvest price option, the policy's worth the same. I've saved my 20% and I still have the same coverage.
Right.
And if I'm wrong and this is not the best price that we see, well, that's not the worst thing in the world, because I haven't locked in anything for myself. I can still take advantage of that run up in the prices.
Right.
I just have to be a little bit more diligent about it, because my crop insurance policy, my margin policy, isn't going to help me if I have a lot of yield losses and the prices are higher in the fall.
Correct.
So that said, I'm with you, Ken. I would take that harvest price for the amount of money that we can save on it.
Be more apt to make a tweak in the protection factor and save some dollars there if that's where you're looking. If you're looking to save some dollars, keep this premium down, do it there.
And with that, that's the end of our margin protection presentation. Any final thoughts, Ken, in general, before we sign off here?
Yeah, I'd say I'm excited to see where this tracking period goes. I'm excited to see where we're starting. And talking to retailers, my retailer on inputs, I know that that side is a big a big shock. So
Sure.
margin is definitely a product to take a look at. Again, like we mentioned before, not a slam dunk by any means, but it does provide some upside protection that we need to at least look at and understand what it can do for us.
Yeah, I guess if you're feeling the pain from checking out prices on your inputs, the easiest way to get rid of that pain is to lock in a price on the crop insurance side of things.
Right.
So with that, thank you for joining us on this special edition of the FMH InsureCast. Please remember to subscribe to our podcasts on your favorite platform, whether it be iTunes, Spotify, etc. And good luck when we get into harvest here.
Thank you.
You've been listening to FMH InsureCast. We appreciate you joining us today and would like to hear from you. If you have questions about today's topic or an idea to share for an upcoming podcast, you can contact us at fmhpodcast@fmh.com. Thanks for listening. This podcast is intended for information purposes only. See policy provisions, terms, and conditions for details. Products underwritten by Farmers Mutual Hail Insurance Company of Iowa and its affiliates, West Des Moines, Iowa. Farmers Mutual Hail is an equal opportunity provider.